People are seeing what's coming by 2027, and I want to give you the single number that explains most of it. Because once you know this one thing, a dozen headlines that look unrelated suddenly turn out to be the same story. S&P Global analyzed loan origination data and found that the commercial real estate maturity wall in this country grows to nearly $1 trillion in 2025 and ultimately peaks in 2027 at $1.26 trillion. Peaks in 2027. And Trepp put roughly $2.2 trillion of commercial real estate debt coming due through the end of 2027. Now here's why that matters to somebody who has never owned a commercial building in their life. Those loans were written in the 2010 at 3 or 4%. They are being refinanced, now at close to double that. Banks and thrifts held $1.844 trillion of commercial and multifamily mortgage debt as of late 2025, which is 37% of all of it. And smaller banks outside the top 25 hold a disproportionate share. Multifamily maturities go from about $104 billion in 2025 to $162 billion in 2026 to $168 billion in 2027. Multifamily means apartments. Apartments mean rent. 2027 is not a prediction, it's a due date. Let me walk you through it. Everything got kicked down the road, and the road ends in 2027. Let me start with what actually happened over the last 3 years, because I don't think most people have any idea, and it's genuinely the most important thing to understand about the next two. There's a phrase in the commercial real estate industry that tells you everything. It's called extend and pretend. Here's what it means. Somebody bought an office building or an apartment complex in, say, 2015. They financed it with a loan at 3.5% on a 10-year term, based on what the property was worth then and what it earned then. That loan comes due. And now the world is completely different. Interest rates are roughly double. Office buildings are worth substantially less because half the workers never came back. And the new loan the bank would write is smaller, because banks size loans to what a property earns and what it's worth today. So the borrower has a gap. They owe more than the new loan will cover. At that point, the bank has two choices. It can foreclose, take the property, and recognize a loss on its own books, which is unpleasant and which regulators and shareholders will notice, or it can extend the loan. Give the borrower another year or two, modify the terms, kick the decision into the future, and hope that rates come down and values recover in the meantime. Guess which one they picked. Since 2023, lenders have consistently extended, modified, and restructured loans. That's a direct observation from a national director of capital markets analytics who tracks this professionally. And it explains something that has confused a lot of people, which is why we've been hearing about a commercial real estate crisis for 3 years, and nothing seems to have happened. Nothing happened because everybody agreed not to let it happen yet. And here's the part that matters. As one analysis put it, every extension that expires unsolved doesn't disappear. It rolls forward and lands on top of the loans already scheduled to mature. Read that again, because it's the whole mechanism. The 2024 problem that got extended 2 years is now a 2026 problem. The 2025 problem that got extended is now a 2027 problem. And those extended loans land on top of the loans that were always scheduled for 2027, which is exactly why 2026 and 2027 look more imposing than 2025 did. The hard decisions got deferred into the wall, not around it. Now, the entire strategy rested on a single assumption, and I want to name it clearly. The assumption was that rates would come down in time. That was the bet. Extend for 2 years, rates fall, refinance at a reasonable number, everybody walks away fine. And it was a completely rational bet in 2023, because almost every forecaster expected significant rate cuts. The industry even had a slogan for it, survive till 25, and 2025 came and went without the rescue. So here we are, the extensions are expiring. The rates did not fall the way everybody assumed. And the volume of decisions that have to actually be made rather than deferred is peaking in 2027 at $1.26 trillion. That's not a forecast about the economy. That's a calendar of contracts that already exist, with dates already printed on them. And that's why I say 2027 is not a prediction. Somebody signed those loans years ago. The dates were always there. We just spent 3 years agreeing to look away from them. And I want to be fair about why they did it, because it's easy to make this sound like a conspiracy, and it wasn't one. Extending was frequently the correct decision. If a borrower is a competent operator with a good property that's temporarily underwater because rates moved, foreclosing serves nobody. The bank ends up owning a building it doesn't want to manage, sells it into a bad market at a bad price, and takes a larger loss than it would have by waiting. Regulators actually encouraged flexibility. on the reasonable theory that an orderly workout is better than a wave of forced sales that crashes values for everybody. So extend and pretend was, in a lot of individual cases, genuinely the right call. The problem isn't any single extension. It's what happens when everybody makes the same reasonable individual decision at the same time, based on the same assumption about rates, and the assumption turns out to be wrong. Then you don't have a series of manageable problems spread across 5 years. You have all of them arriving in the same 18 months, in a market where the buyers who might absorb them are dealing with their own maturities. That's the actual risk, not that anybody behaved badly. That everybody behaved sensibly in the same direction at the same time, and that's how you build a wall. There is a thing called a rate cap, and almost nobody outside the industry knows about it. Now let me tell you about the mechanism that I think is the most under-discussed thing in American finance right now, because it's technical and boring, and it is going to force a lot of decisions earlier than anybody expects. It's called a rate cap. Here's how it works. A lot of commercial real estate loans, particularly the short-term bridge loans used by apartment investors, are floating rate, meaning the interest rate isn't fixed, it moves with market rates. Lenders don't like unlimited exposure to that, and neither do borrowers. So the borrower is typically required to buy something called an interest rate cap, which is essentially an insurance policy. It sets a ceiling. If rates go above a certain level, the cap pays the difference. Those caps have terms, usually 2 or 3 years, and then they expire. Now, when a huge number of these loans were written in 2021 and 2022, rates were near zero, so a cap was cheap. You could buy protection for a modest sum because nobody thought rates were going anywhere. Then, rates went up dramatically, which means the replacement cost of a cap went up enormously, in some cases by a factor of 10 or more. And here's what happens when a cap expires and the borrower has to buy a new one. Or worse, can't. As one industry analysis put it, floating rate borrowers with rate caps expiring in 2026 cannot coast to their maturity date. When the cap expires and the uncapped rate hits, the debt service math breaks immediately. The sponsor is forced to the table before they plan to be. Forced to the table before they plan to be. That's the key phrase, and it explains why the trouble arrives before the maturity date rather than on it. So picture it. An apartment complex bought in 2021, financed with a floating rate bridge loan that matures in 2027. The owner has been planning around that 2027 date, but the rate cap expires in 2026, and suddenly the monthly payment jumps, and the property doesn't generate enough to cover it. That owner is in trouble in 2026 over a loan that isn't due until 2027 because of an insurance policy expiring that most people have never heard of. And a significant portion of the bridge loan vintage from 2021 and 2022 is hitting that window right now. There's a second early trigger worth knowing about too, and it's leases. If a building has a major tenant whose lease expires in late 2026 or early 2027, the lender sizing a new loan is going to assume the worst about whether that tenant renews. Credit committees size to the downside on unresolved rollover risk. So a borrower who needs a certain loan amount to pay off the existing debt might only qualify for substantially less, purely because a lease question hasn't been answered yet. That's a gap that has to be filled with somebody's cash before the maturity date, not at it. And the analysis I read on this put it in a way I found genuinely chilling. 3 patterns. All of them visible now, none of them announced. That's the situation. Everything I'm describing is knowable today, sitting in loan documents, on schedules that exist, and most people treating 2027 as next year's problem are already behind. Let me put a number on why this matters, because the scale of the rate move is the thing that makes it unsolvable rather than merely difficult. An analysis comparing the average interest rate on newly originated commercial real estate loans against the rate on the mortgages that were maturing found a jump of nearly 200 basis points. That's 2 full percentage points. Now apply that to a real building. A property carrying $20 million of debt at 4% pays $800,000 a year in interest. At 6%, it pays $1.2 million, $400,000 a year. Out of the same building, generating roughly the same rent. That money has to come from somewhere, and there are only 4 places: higher rents, if the market allows, lower expenses, meaning maintenance and staff, the owner's pocket, which works until it doesn't, or a fresh injection of equity, which means somebody has to write a check for the privilege of keeping a building they already own. That last one is the decision facing an enormous number of owners right now, and a lot of them are going to decline. Not because they're broke, because putting $4 million of new equity into a building worth less than the loan is throwing good money after bad, and any competent investor knows it, which is how a property ends up back with the lender. Nobody did anything wrong. The arithmetic simply stopped working, and everybody involved could see it coming for 2 years. Small banks are holding the bag, and they are the ones on your main street. All right, now let me connect this to something you actually care about, which is whether your money is safe and whether your local bank stays open. Here's the concentration picture. Banks and thrifts held $1.844 trillion of commercial and multifamily mortgage debt in the third quarter of 2025. That's 37.4% of the total, which makes banks by far the largest single holder. For comparison, agency and government-sponsored enterprise portfolios held about 22.5%, life insurance companies about 16%, and commercial mortgage-backed securities and similar instruments about 13%. So more than a third of this entire wall sits on bank balance sheets. But the crucial detail is which banks. Among domestically chartered commercial banks, smaller institutions outside the top 25 hold a disproportionate share of commercial real estate exposure relative to their size. That's the thing to understand. This is not primarily a problem for the enormous national banks whose names you see on stadiums. Those institutions have diversified businesses, credit cards, investment banking, wealth management, trading. Commercial real estate is one line among many. For a regional or community bank, commercial real estate can be an enormous share of the entire loan book. It's what they do. They lend to local developers, local landlords, local businesses buying their own buildings. That's the business model, and it's been a good one for decades. Which means the concentration risk sits precisely where the capacity to absorb losses is smallest. And you can already see stress showing up in the data. The commercial mortgage-backed securities special servicing rate, which is the share of loans that have been transferred to a specialist because the borrower is in trouble, has been climbing to levels not seen in years. In the retail sector specifically, one analysis found a category of older loans running an 80% delinquency rate and 85% in special servicing. Now, I want to be balanced here, because I am not predicting bank failures, and I don't want anybody panicking. The regulators have been watching this closely for 3 years. Banks have been building reserves against these losses. Many have been reducing their exposure deliberately. And in most cases, an extended loan that eventually gets resolved at a loss is a hit to earnings rather than an existential threat. And there's a genuine argument from the industry side that this is manageable. Analysts have pointed out that despite the maturity wall, distress has not materialized at scale, and that well-located quality properties are refinancing fine. That's true, and it deserves to be said. But here's what I'd say to you practically. And it's the same thing I'd say about anything involving a bank. Know your FDIC coverage. $250,000 per depositor, per insured bank, per ownership category. If you have more than that at a single institution, restructure it across multiple banks or different ownership categories and do it on an ordinary Tuesday when nothing is happening rather than during a panic. And understand that the $250,000 limit has not been raised since 2010. 16 years of inflation have eroded its real value substantially. The protection your parents had is not the protection you have. Keep at least 2 banking relationships. If there's ever an operational problem at one, you are not locked out of your own money. And if your local bank is one you care about, and a lot of people do care about theirs, understand that its health depends on a commercial real estate book that is under more pressure than it has been in decades. That's not a reason to move your money. It is a reason to know your coverage limits. And let me add one thing about how bank trouble actually shows up, because people imagine it wrong. Almost nobody experiences a bank problem as a bank failing. Since 2008, the overwhelming majority of troubled banks in this country have been acquired rather than liquidated, usually over a weekend, and depositors woke up on Monday with a different name on the building and their money entirely intact. What people actually experience is something much quieter. Branches close, the one in your town gets consolidated into the one 20 minutes away, which matters enormously if you're older and don't drive at night. Lending standards tighten. The loan you would have gotten 2 years ago gets declined, or approved at a worse rate, and nobody explains that the reason has nothing to do with you. Fees appear or increase. Minimum balance requirements go up, free checking becomes conditional. Relationship banking disappears. The manager who knew your name takes a package, and the person who replaces her is following a decision system rather than knowing your history. That's the real consequence for ordinary customers, and it's already been happening for years in small-town America. A commercial real estate workout accelerates it. So the practical response isn't fear about your deposits. It's understanding that the local branch you rely on is not guaranteed to be there, and having a second relationship set up before you need it. Multifamily means apartments, and apartments mean your rent. Now let me get to the part that reaches ordinary people most directly, because everything I've described so far sounds like it's about investors and buildings, and it isn't. Multifamily is the term for apartment buildings, and the multifamily maturity picture is one of the sharpest parts of this whole wall. The numbers go like this. Roughly $104.1 billion of multifamily loans matured in 2025. That jumps 56% to about $162.1 billion in 2026, and it edges higher to $167.7 billion in 2027, a two-year peak, in the sector that houses a huge share of American renters. And here's how that reaches your rent. An apartment building is a business. It has revenue, which is rent, and expenses, which include the mortgage. When the mortgage payment goes up dramatically because a loan written at 3.5% is refinanced at 7%, the owner has to find that money somewhere. There are only three places it can come from. Rent increases, expense cuts, which means deferred maintenance and reduced staffing, or the owner absorbs it, which they will do only as long as they can. So the practical consequences for renters over the next 2 years are fairly predictable. Upward pressure on rents, slower maintenance response, fewer amenities, properties changing hands, sometimes to owners with a very different approach. Now, I want to be honest about a complication, because rent is set by supply and demand in a local market, not by an individual landlord's debt service. A landlord with a payment problem cannot simply charge more if the market won't bear it, which is why the more common outcome, and the one I'd expect, is not a rent spike, it's a degradation. The building gets worse, the repairs take longer, the parking lot doesn't get resurfaced, the old carpet stays, because that's the expense line an owner actually controls. And in the worst cases, buildings go into receivership, or get sold at distressed prices, and the transition period is genuinely difficult for the people living there. There's a second-order effect worth mentioning too, and it's one nobody talks about. A lot of new apartment construction has been financed with exactly the kind of short-term floating-rate debt we've been discussing. When that financing gets harder to obtain, new construction slows, and less new construction, 2 or 3 years out, means less supply, which means upward pressure on rents down the road. So the near-term effect of a refinancing crunch is buildings getting worse, and the medium-term effect is fewer new buildings getting built, which is worse for affordability. That's an uncomfortable combination, and it's one of the reasons I think the housing affordability picture in this country does not improve on the timeline most people are hoping for. If you're a renter, here's the practical piece. Renewal time is your leverage point. If your building has visibly declined, that's a negotiating position, and property managers who are dealing with an owner under financial pressure frequently have more flexibility on rent than on capital improvements, because rent is a decision they can make and a new roof isn't. Ask politely, specifically, in writing. The worst outcome is that they say no. And if you're in a building that changes hands, read whatever you're asked to sign very carefully, and know your state's rules about lease terms surviving a sale, because in most places they do. There's one more angle on multifamily worth naming, and it's the one that affects older Americans most directly. A great many senior housing and affordable housing properties are financed with exactly the same kinds of loans, some through agency programs, some through tax credit structures, some through ordinary commercial debt. When those properties face refinancing pressure, the consequences are more serious than at a market-rate building, because the residents have fewer options and less capacity to absorb a move. And there's a specific mechanism worth knowing about. Affordable housing built with certain federal tax credits carries an affordability period, and when that period expires, the owner can in some cases convert the property to market rate. Owners facing a refinancing squeeze have an obvious incentive to look hard at that option. So if you or a family member lives in income-restricted senior housing, it's genuinely worth finding out when the affordability restriction on that property expires. It's usually public information. Your state housing finance agency tracks it, and the answer determines whether you have 5 years of stability or 20. Almost nobody asks, and it's the single most consequential fact about where they live. Waiting for the Fed to fix this is waiting for the wrong number. I want to address the hope that underlies almost everything I've described, because a great many people are relying on it, and I think it deserves a hard look. The hope is that the Federal Reserve cuts rates, and this all gets easier. And there are 2 problems with that, and the first one is genuinely surprising to most people. Real estate is not priced off the Fed funds rate. The Fed funds rate is an overnight rate between banks. It affects short-term borrowing, and it influences things like credit card rates and home equity lines. Long-term real estate lending, and the 30-year mortgage for that matter, is priced off longer-dated Treasury yields, particularly the 10-year. And here's the thing that confuses people. Those two do not always move together. Treasury yields have moved up during stretches when the Fed was actively cutting. Why? because the long end of the yield curve is set by a different market with different concerns. Inflation expectations. The volume of treasury debt being issued. What foreign buyers are doing. The term premium investors' demand for lending to the government over long horizons. So a Fed cut can be announced and celebrated, and mortgage rates can go up that same week. It's happened. As one analysis put it directly, waiting for a Fed cut to rescue your refinance is waiting for the wrong number. The second problem is the calendar. Even if relief did come, the calendar doesn't clear. Heavy maturities run all the way through at least 2030 on most estimates. This is not a single bad year to grit your teeth through. And there's a third issue that I think is the most important one, and that almost nobody mentions. The gap between what these loans cost and what refinancing costs is very large. One analysis compared the average interest rate on loans being originated against the rate on the mortgages maturing, and found a jump of nearly 200 basis points, meaning 2 full percentage points. A rate cut of a quarter point or even a full point does not close a 2-point gap, it reduces it. That helps at the margin, and it does not solve the arithmetic for a property that is underwater. Which means that even in a genuinely favorable scenario where the Fed cuts several times and long rates follow, a substantial share of these loans still don't work. Now, let me give the honest counter-argument, because there is a real one. And I've been giving you the bearish case. Distress has not materialized at scale. That's a genuine observation, and it's been true for 3 years running. Well located, quality properties with good tenants are refinancing successfully. The retail sector, which everybody assumed would be a disaster, has actually held up better than expected, with stable returns, above-average occupancies, and rising net operating income supporting refinancing in most cases. And the extend and pretend strategy, whatever you think of it, has bought genuine time during which some properties have improved their operations and some markets have recovered. So the reasonable expectation is not a cliff. It's a grinding, multi-year workout, concentrated in the weakest assets and the most exposed lenders, that shows up as reduced lending capacity rather than dramatic failures, which, honestly, might be worse for ordinary people. A dramatic failure gets fixed. A grinding reduction in credit availability just makes everything slightly harder for years, in ways nobody attributes to anything. The other clock's running out around the same time. Let me widen this out now, because commercial real estate is the biggest 2027 item, but it is not the only one. And the reason people are shocked is that several timers happen to be converging. The debt ceiling. The 2025 legislation raised the federal debt limit by $5 trillion, taking it from about $36.1 trillion to $41.1 trillion. That was the largest single increase in American history, and analysis from the Peter J. Peterson Foundation concluded that at the current pace of borrowing, that entire $5 trillion will be consumed in roughly 2 years, which puts the next debt ceiling standoff somewhere in 2027, and that fight will happen with the debt higher, the interest cost larger, and the fiscal capacity smaller than it was for the last one. Interest payments on the federal debt have already crossed $1 trillion a year, more than the defense budget. Medicare's Part D changes. For the 2027 plan year, the Part D deductible rises to $700, and the annual out-of-pocket cap on prescription drugs rises to $2,400. Those numbers move every year, and they move upward. And 2027 is the plan year people are choosing during the enrollment window that opens each October. The Social Security clock. The retirement trust fund is projected for depletion around 2032 or 2033, with an automatic benefit cut of roughly 23% at that point under current law. That's not 2027. But 2027 is when the political fight about it has to begin in earnest if there's going to be a gradual solution rather than a sudden one, because every year of delay makes the required fix larger. The student loan transition. The SAVE plan sunsets in July of 2028, with borrowers required to move to another plan by that date. PAYE and ICR are phasing out on the same timeline, which means the migration of millions of borrowers happens across 2027 and into 2028, through a Department of Education that has been substantially downsized. And the physical automation question. I've talked before about AI displacing white-collar work, which is happening now and is measurable. What has not happened yet at scale is robotics reaching physical and manual work. Researchers looking at the pace of adoption have flagged 2027 as a plausible window for when manufacturing and construction begin experiencing what office work is experiencing now. I treat that one with more caution than the others, because technology timelines are notoriously wrong and the physical world is much harder than people assume. But the direction is not really in dispute. Now, why does convergence matter? Why does it matter that several things land in the same window rather than being spread out? Because capacity to respond is finite. A country can handle a commercial real estate workout. It can handle a debt ceiling fight. It can handle a benefits transition. What is difficult is handling all of them in the same 18-month period, with a Congress that has demonstrated limited ability to address any single structural problem in an election cycle. That's the actual risk, not any individual item. The simultaneity. And there's a political dimension to the timing that I'd be leaving something out if I didn't mention. 2027 is the year after a midterm election, and the year before a presidential one, which means it is structurally the worst possible year in the American calendar for difficult decisions. The incentive in that window is to defer anything painful past the next election, and the party in a position to act has every reason to wait, and the party out of power has every reason to block. I'm not making a partisan point. This is true regardless of who holds what, and it has been true for decades. Hard fiscal decisions get made in the first year of a term, occasionally, and almost never in the year before a presidential race. So the year when a large volume of deferred decisions comes due is also the year when the federal government is least likely to do anything about any of it. That's not a conspiracy either, it's just the calendar, colliding with another calendar. And I want to be clear that I'm not predicting a collapse. I don't think 2027 is the end of anything. What I think is that 2027 is when a large number of deferred decisions stop being deferrable, and that periods like that are historically when policy gets made badly and quickly rather than well and slowly. Office buildings are the part everybody talks about and the part nobody can price. Let me deal with offices specifically, because it's the sector that gets all the headlines and the situation there is genuinely different from the rest. Here's what happened, and it happened fast. Before 2020, an office building was one of the safest assets in commercial real estate. Long leases, credit-worthy corporate tenants, predictable income. Insurance companies and pension funds loved them precisely because they were boring. Then everybody went home, and a very large share never fully came back. Hybrid work is not a temporary arrangement anymore. Companies that downsized their footprints in 2021 and 2022 have not reversed it. Leases that expire get renewed for less space, or not renewed at all. And here's what that does to a building's value, and the mechanics matter. A commercial property is valued primarily on the income it produces. So if a building was fully leased and is now 65% leased, and the rents on renewal are lower than they were, the income falls substantially. Then separately, the rate used to convert that income into a value goes up, because buyers demand a higher return for taking on a riskier asset in a higher rate environment. Falling income divided by a higher required return produces a dramatically lower value. Both variables move the wrong way at once, which is how you get buildings selling for a fraction of what they were worth 6 years ago in cases where they sell at all. And that brings me to the thing that has made this whole situation so strange, which is that for a long stretch, transactions essentially stopped. As one industry account described it, valuations calculated at pre-pandemic highs grew too stale for buyers to trust them, and the uncertainty around what an office is worth in the era of hybrid work was overwhelming. When nobody transacts, nobody knows what anything is worth, which means the value on a bank's books is an estimate that has not been tested by an actual sale. That's the quiet issue underneath the entire office story. Not that values fell, that nobody knows by how much, because the market that would tell you went quiet for 3 years. And a maturity forces the question. When a loan comes due, somebody has to appraise the property, and that appraisal is a number that becomes real. There's a case that stuck with me. Chicago's Prudential Plaza, where the owner spent $40 million in January of one year simply to obtain a 2-year extension on a roughly $386 million loan, $40 million for 2 more years. That is what it costs to defer a decision on a building of that size, and it tells you exactly how much the parties involved wanted to avoid finding out what it was actually worth. Now, does this matter to somebody who doesn't own an office building? Yes, in 3 ways. It matters to your city's tax base, because commercial property taxes fund municipal services, and when downtown values fall, that revenue falls with them, and the gap gets made up somewhere else. Usually residential property taxes and fees. It matters to downtown economies because the sandwich shops and dry cleaners and parking garages that served office workers have already been struggling for 6 years. And it matters to bank lending capacity, which is the mechanism I described earlier. One thing worth watching, and it's genuinely hopeful: conversions. A number of cities have begun converting obsolete office buildings into apartments, and some have created tax incentives to encourage it. It's technically difficult and expensive, because office floor plates and plumbing weren't designed for residential use, and not every building can be converted. But in a country with a housing shortage and an office surplus, that's the obvious trade, and where it works, it solves 2 problems at once. If your city is doing it, That's a genuinely good sign for your downtown. Here is how a refinancing problem turns into a job problem. Let me draw the line from all of this to employment, because I think it's the connection people miss, and it's the one that actually reaches households. Here's the chain, and every link in it is ordinary. A bank has a large commercial real estate book. Loans start coming due. Some get resolved at a loss. The bank takes a hit to earnings and to capital. Now, what does a bank do when its capital position tightens? It does not primarily stop making commercial real estate loans, though it does some of that. It reduces lending generally, because every loan requires capital to be held against it, so the small business loan gets harder to obtain. The equipment financing gets more expensive. The line of credit that a local contractor uses to make payroll between jobs gets reduced at renewal, and that lands on employment, in that community with a lag of a year or two, and nobody attributes it to a commercial mortgage that matured in another state. That's how a technical financial event becomes a job market event. Not dramatically, through credit availability. And there's a second channel that's more direct: construction. Commercial real estate development is financed with exactly the kind of debt we've been discussing. When that financing becomes difficult, projects don't start. And construction is an enormous employer of people who work with their hands, in a sector that historically has provided some of the best-paying jobs available without a 4-year degree. A slowdown in commercial construction is felt by electricians, plumbers, framers, equipment operators, suppliers, and the businesses that serve construction sites. And there's a third, which is property management and building services, janitorial, security, maintenance, landscaping. When a building's income falls and the owner cuts expenses, these are the first contracts renegotiated, and the people doing that work are among the lowest paid in the economy. So the practical thing I'd say to somebody watching this who works in or near any of those fields is simply this: watch your local pipeline. Are projects breaking ground in your area, or are they being announced and then quietly not starting? That's an observable thing, and it's a better leading indicator for your own employment than any national statistic. Talk to people in your trade about what work is booked for next year, rather than what's happening now. In construction, the forward book tells you far more than the current site does. And if the forward book is thinning, that's the moment to build the buffer and update the skills, not 18 months later when it's obvious. Now let me say the balancing thing, because I've now spent a long time on the bearish case. None of this is certain, and the industry's own analysts make a reasonable argument that it's manageable. Distress has not materialized at scale in 3 years of everybody predicting it would. Lenders have shown enormous willingness to work with borrowers. Well-located quality assets are refinancing, and the American economy has repeatedly absorbed things that looked catastrophic in advance. The honest expectation is not a crash, it's friction. Slower lending, fewer projects, thinner margins, and a grinding workout concentrated in the weakest assets. But friction over several years, arriving on households that have a 2.6% savings rate and no buffer, produces real hardship even without a single dramatic headline. That's the version I'd plan for. Not a crash you can point at, a tightening you can feel and can't quite name. What ordinary people should actually do with the next 18 months. So let me get practical, because a video that describes a wall and offers nothing is just anxiety with citations. Here's what I'd actually do, and I'm going to put these in order of how much they matter for a normal household. First, and by a wide margin, reduce your variable rate debt. Everything I've described in this video is a story about people who borrowed cheaply and have to refinance expensively. You do not want to be in that position personally. Credit card balances, home equity lines of credit, and any adjustable rate loan are the exposures that get worse without you doing anything. Attack those first. Fixed rate debt at a low rate, particularly a mortgage from a few years ago, is the opposite situation, and paying that off early is usually the wrong priority. Second, build the buffer, and size it honestly. 6 months of your actual floor, not 3 months of your lifestyle. The floor is housing, utilities, food, insurance, medications, transportation, and minimum debt payments. For most households, that's meaningfully less than current spending, which makes the target less frightening than it sounds. And keep it somewhere earning something. A high-yield savings account or a treasury money market fund. Not in a checking account earning nothing, and not invested in something that can be down 30% on the day you need it. Third, know your FDIC coverage cold. $250,000 per depositor, per insured bank, per ownership category. Restructure if you're over, and do it on a calm afternoon. Fourth, if you're within about 5 years of retirement in either direction, this is the period where sequence of returns risk peaks. Have a couple of years of spending needs in cash and short-term safe assets so you are never forced to sell investments during a downturn to pay a bill. That single arrangement removes the mistake that permanently damages a retirement. Fifth, if you rent, understand that your building's economics may be under pressure and that renewal time is your leverage point. Ask. Sixth, if you own a home and were planning to sell or downsize in the next few years, think about the sequencing deliberately rather than defaulting. I'm not telling anybody to sell, I'm saying that a decision you were going to make anyway is worth making on purpose. Seventh, and this is the one nobody does. Look at your own local exposure. Everything in this video is national, and none of it lands nationally. It lands in specific places, so ask what your local economy actually runs on. If your metro has a large office footprint downtown, or a major employer that occupies a lot of leased space, or a local bank with heavy commercial lending, your area has more exposure than a place that doesn't. That's not a reason to move. It's a reason to have a bigger buffer if you're in one of those places, because in a regional downturn, everybody looks for work at the same time, and job searches take longer. And there's a specific thing you can look up that almost nobody does. Your city's downtown office vacancy rate. Local business journals publish it quarterly, and commercial brokerages publish market reports for free. If your downtown vacancy is in the low teens, your city is basically fine. If it's north of 25%, your municipal tax base has a problem coming, and that problem eventually arrives as your property tax bill and your county services. 5 minutes to look up. It tells you more about the next 5 years in your town than any national headline will. And eighth, the one that isn't financial at all. The people who come through periods like this in decent shape are almost never the ones who predicted correctly. Almost nobody predicts correctly. They're the ones who weren't overextended when it arrived, who had skills that stayed useful, and who had people who would show up. Every one of those is something you can work on in 18 months. None of them requires knowing what happens. Let me finish with the thing I most want you to take away. There's a difference between a forecast and a schedule. A forecast is somebody guessing about the future, and the historical accuracy of economic forecasting is genuinely poor, and anybody telling you a specific date for a recession is making it up. A schedule is a list of contracts with dates already printed on them, loans that mature, programs that expire, statutory deadlines already in law. Everything I've told you today is in the second category. $1.26 trillion of commercial mortgages maturing in 2027 is not a prediction. Somebody signed those documents years ago. The reason people are shocked when they finally look at it is not that anybody hid it. It's that it's published in industry reports that ordinary people never read, and by the time it becomes a headline, the decisions have already been made by somebody else. You've now looked at it. That puts you 18 months ahead of nearly everybody you know. Use the time. Take care of yourselves out there, and if you know somebody who works in construction, or banks locally, or rents an apartment in a building that changed hands recently, send them this. Not to worry them, because the single most valuable thing about a schedule, as opposed to a forecast, is that you can act on it in advance, and 18 months is genuinely enough time to change your position. The people who get hurt in something like this are almost never the ones who saw it coming and did something modest. They're the ones who found out in the same week they needed the money.